Hey everyone, welcome back. I'm Dee and I'm here to share with you the top 100 mortgage vocab words when you're practicing for the NMLS Mortgage Loan Originators Licensing Examination. And if you stick around till the end, I'm going to give you a little bonus. I'm going to share with you my top 10 acronyms that you ought to memorize for this exam. Without further ado, let's get into them. Home equity loan. A type of loan where borrowers leverage the equity in their home to borrow a lump sum of money up front, which is then repaid over a fixed term with set monthly payments. Qualifying ratios. A calculation used by lenders to evaluate the risk of lending to a borrower by comparing their gross monthly income to their monthly debt payments, determining how large of a loan they can responsibly handle. Loan flipping. An unethical lending practice that encourages a borrower to repeatedly refinance a loan, often without any real financial benefit to the borrower, so the lender can continue to collect multiple origination fees. Basis point. 1/100th of a percentage point, often used to quantify small percentage changes in interest rates. Fair Credit Reporting Act. A federal law established in 1970 that regulates the collection, dissemination, and use of consumer credit information to ensure accuracy and privacy of that information. Mortgage broker. An intermediary who assesses a borrower's financial situation and shops across multiple lenders to find the best mortgage terms and rate. Subprime mortgage. A loan with an interest rate that is higher than the prime rate, typically extended to borrowers with lower credit scores or other risk factors that prevent them from qualifying for a prime rate loan. Fixed rate mortgage. A type of home loan where the interest rate remains constant throughout the term of the loan, providing predictable monthly payments for the borrower. Equity skimming. A fraudulent practice in real estate where an individual or investment entity acquires ownership of a property and then extracts the equity from that property through a refinance without fulfilling their financial obligations, such as paying the mortgage loan or property taxes. Note, equity skimming is often used in foreclosure rescue schemes.
Hey everybody, just a quick request. If you're getting some value out of this video, please be sure to like and subscribe because the more the channel grows, the more free content we can put together for y'all. Thank you so much, and let's get back into it.
Credit history. An individual's record of financial behavior, primarily debt repayment over time. It includes past and current loans, outstanding balances, payment history, credit cards, and more, and is used as a guide to help determine one's credit worthiness. Foreclosure. A legal process through which a lender or creditor takes possession of a property due to the borrower's failure to make mortgage payments in order to recover all or some of the outstanding debt. Foreclosure is a type of involuntary alienation. The Homeowners Protection Act of 1998. Legislation that requires the termination of private mortgage insurance for residential mortgages once there is a sufficient equity in the home. It also requires lenders to provide borrowers with information at closing about both automatic PMI termination and borrower-requested cancellation. Partially amortizing loan. A type of loan in which regular payments do not fully repay the principal by the end of the loan term, requiring a large lump sum payment for the remaining balance. Margin. The fixed percentage that is added to an index rate to determine the total interest rate on an adjustable rate mortgage. Housing expense ratio. A metric used to determine how much of a borrower's gross monthly income is dedicated to the housing cost by dividing the total monthly housing expenses by the borrower's gross monthly income. Credit score. A numerical score that represents an individual's creditworthiness, reflecting their likelihood of repaying borrowed funds based on their credit history, income, debts, and other factors. Entitlement. The maximum amount that the Department of Veterans Affairs will provide to a borrower for VA-backed mortgages. Prepaid interest. Charges due at closing for any daily interest that will accrue on a mortgage loan between the date of closing and the end of the month before the regular mortgage payments begin. Home equity line of credit, HELOC. A type of revolving loan where homeowners can borrow against the equity in their property. A HELOC is a flexible source of funds that uses the property as collateral as needed, as opposed to the home equity loan, which is a fixed amount. Non-traditional mortgage product. Any type of mortgage that does not conform to the standard fixed-rate mortgage model, such as adjustable-rate mortgages, interest-only mortgages, and balloon mortgages. Hazard insurance. Insurance coverage that compensates the policyholder for property damage caused by hazards such as fire, theft, or vandalism. Acceleration clause. The acceleration clause is the right of a lender to require the remaining balance of a mortgage loan to be paid in full. Good faith estimate. The good faith estimate is a document that a lender provides to a borrower that outlines the estimated costs associated with the mortgage loan, including fees, interest rates, and closing costs. High-cost loan. A high-cost loan is a type of loan that charges significantly higher interest rates or fees than the average loan. Under the Dodd-Frank Act's amendments under HOPA, a high-cost loan is considered to be one that is 6.5% higher than the average prime offered rate for the first mortgage and 8.5% higher for a second mortgage. Alt-A loan. A type of mortgage that falls between prime and subprime loans in terms of credit risk that are typically offered to borrowers who may not qualify for prime loans due to certain risk factors, such as high debt-to-income ratios, but are still considered less risky than prime borrowers. Non-qualified mortgage, or non-QM. A type of home loan that does not meet the criteria set by the Consumer Financial Protection Bureau for qualified mortgages and is designed to accommodate borrowers who may have unique financial situations that don't fit traditional lending standards. Mortgage servicer. A mortgage servicer is the lending company or entity that collects and manages the monthly mortgage payments from a borrower. Front-end ratio. The percentage of a borrower's gross monthly income that goes towards housing expenses. For example, if a borrower earns $6,000 a month and their total monthly housing costs are $1,500, the front-end ratio would be 25%. $1,500 divided by 6,000 or 0.25, also known as 25%. The Secure and Fair Enforcement for Mortgage Licensing, or SAFE Act. Enacted in 2008 in response to the mortgage crisis to enhance consumer protections and reduce mortgage fraud by setting minimum standards for the licensing and registration of state-licensed mortgage loan originators. Creditor. A creditor is any entity that lends money or extends credit to another party, for example a bank or a credit card company, with the expectation of repayment from the borrower. Annual escrow statement. The annual escrow statement, also known as the escrow account disclosure statement, is a document that outlines the amounts paid towards a borrower's escrow account, account projections for the next year, and any surpluses or shortages. Bi-weekly payment plan. A biweekly payment plan is a mortgage payment plan where the borrower makes half of their monthly payment every 2 weeks instead of the full amount once per month for a total of 26 half payments or 13 full payments per year. This increases the amount of the principal balance paid off each calendar year, decreasing the amount of interest paid over time and speeding up the loan payoff date. FHA loan. A government-backed mortgage insured by the Federal Housing Administration, designed to enable lower-income and first-time homebuyers to purchase homes with lower down payments and credit requirements. Jumbo loan. A jumbo loan is a type of home loan that exceeds the conforming loan limits set by the government-sponsored entities such as Fannie Mae and Freddie Mac, typically used to finance higher-priced properties. The Patriot Act. The USA Patriot Act is a law enacted in response to the September 11th attacks, aimed at enhancing national security by expanding law enforcement's ability to surveil, investigate, and deter terrorist operations. In terms of lending, it aims to identify and prevent money laundering by enforcing stricter identification and reporting requirements for financial institutions. Dodd-Frank Act. The Dodd-Frank Act is a federal law designed to promote economic stability by regulating the financial industry and improving transparency to enhance consumer protections by protecting them from predatory lending practices. It was created in response to the 2008 financial crisis, which revealed significant flaws in the financial system. Amortization. Amortization is the gradual repayment of a loan over time through scheduled installments, which includes both principal and interest until the total amount is fully paid off. Consumer Financial Protection Act. The Consumer Financial Protection Act, also called as Title X, is the federal law that protects consumers during financial transactions, granting authority to the Consumer Financial Protection Bureau to enforce rules ensuring fair and clear practices in banking and lending. Interest rate. The percentage charged by a lender on the principal loan amount. It represents the cost of borrowing money. Freddie Mac. Freddie Mac stands for the Federal Home Loan Mortgage Corporation, a publicly traded government-sponsored secondary mortgage market enterprise. Primary mortgage market. The primary mortgage market is the main mortgage loan marketplace where lenders originate new mortgages and borrowers obtain financing directly from these lenders. Balloon mortgage. A balloon mortgage, also called a partially amortized loan, is a type of loan with a shorter repayment term, typically lasting 5 to 7 years. During this period, borrowers make regular payments, but at the end of the term, there's a large final payment called a balloon payment due to cover the remaining outstanding balance. Demand clause. A demand clause is a provision in a contract that allows a lender to demand repayment at any time, even if it is before the maturity of the loan. Yield spread premium, or YSP. A fee received by a mortgage broker from a lender for originating a loan at an interest rate higher than the market rate. YSP must be disclosed during the mortgage process. Mortgage banker. A mortgage banker is a direct lender who manages the entire loan process from origination to servicing. Closing agent. A closing agent, also known as a settlement agent or escrow agent, is a neutral third party responsible for facilitating the real estate closing process by ensuring that all necessary documents are properly executed, funds are transferred, and ownership of the property is transferred from the seller to the buyer in accordance with the terms of the purchase agreement and applicable laws. Loan processor. A loan processor is an individual who works in a support capacity to assist the loan originator with the clerical duties and paperwork involved in the lending process. HUD-1 Settlement Statement. A HUD-1 settlement statement is a document provided at closing which gives a detailed breakdown of all financial transactions related to the closing, including closing costs, prorated taxes, and adjustments between the buyer and seller. Origination fee. The origination fee is a fee a lender charges for the funding of a mortgage loan. Hypothecation. Hypothecation is the process of pledging an asset as collateral to secure a loan or mortgage. The Fair and Accurate Credit Transactions Act, or FACTA. FACTA is a federal law enacted in 2003 aiming to enhance consumer protections in relation to credit reporting and identity theft by providing consumers with the right to access their credit report. It allows them to dispute credit report inaccuracies and request fraud alerts and credit freezes to prevent identity theft. Average Prime Offer Rate, APOR. The APOR is the average interest rate that the most creditworthy borrowers in the market qualify for. Derogatory credit. Derogatory credit is negative information on a borrower's credit report that may indicate their inability to repay debts, for example, late payments, defaults, foreclosures, or bankruptcies. Ginnie Mae. Ginnie Mae stands for the Government National Mortgage Association, is a government corporation within HUD that aims to expand the funding of mortgages that are insured or guaranteed by other federal agencies to make affordable housing more accessible for low to moderate income families. The Banking Act of 1933. The Banking Act of 1933, also referred to as the Glass-Steagall Act, is a federal law designed to separate commercial banking from investment banking, aiming to prevent conflicts of interest and reduce the risk of another financial crisis, such as the one leading to the Great Depression. It also created the FDIC, which insured depositors from bank defaults, which allowed the public to feel more confident in saving their money in banks once again. The Housing and Economic Recovery Act, or HERA. HERA is a federal law that was established in response to the 2008 housing crisis that created new regulatory frameworks to improve mortgage lending standards and enhance consumer protections to ensure greater stability in the real estate market going forward. Fully indexed rate. The fully indexed rate is the sum of the current index value and the margin in an adjustable rate mortgage. Verification of deposit. A verification of deposit, or a VOD, is a document that lenders use to verify the current and average amount a borrower has in their bank accounts. Point. A point is a percentage of the mortgage loan amount, with each point equal to 1% of the total loan, typically paid upfront by the borrowers to the lender as a form of prepaid interest in exchange for a reduced interest rate. Unique identifier. A unique identifier is a number assigned to every mortgage loan originator registered under the Nationwide Multi-State Licensing System and Registry, or the NMLS, to track the employment history and compliance records of a loan originator. Federal Deposit Insurance Corporation, the FDIC. The FDIC was created by the Banking Act of 1933. It is a government entity that provides insurance to depositors in U.S. commercial banks and savings institutions. The FDIC is funded by the premiums paid by member banks. Due on Sale Clause. The Due on Sale Clause is a provision in a contract that permits the lender to demand full repayment of the loan when the property is sold or transferred to a new owner. Pre-qualification. Pre-qualification is an initial evaluation done by a lender based on a potential borrower's stated income, assets, and debt to determine the amount of money they might be eligible to borrow. Default. Default is the failure of a borrower to fulfill their contractual obligations, such as failing to make timely mortgage payments. Back-end ratio. The back-end ratio is the percentage of a borrower's gross monthly income that goes towards all monthly debt obligations, including mortgage payments, car loans, credit card debt, alimony, child support, and other debts. Underwriting. Underwriting is the process of evaluating a borrower's creditworthiness to assess the risk associated with the lender providing them a loan. Community Reinvestment Act. The Community Reinvestment Act, or CRA, is a federal law enacted in 1977 that requires Federal Reserve and other federal banking regulators to provide fair and equitable access to credit and banking services for borrowers in all segments of their communities, including low and moderate income neighborhoods. 4 C's of underwriting. The 4 C's of underwriting, the standard criteria used by lenders to assess a borrower's eligibility for a loan, and they include credit, capacity, capital, and collateral. Prohibitions against dual compensation. A regulation that prevents mortgage brokers and MLOs, or mortgage loan originators, from receiving compensation from both the borrower and the lender for the same loan transaction. Annual Percentage Rate, or APR. The APR is a standardized calculation that reflects the total cost of borrowing, including both the interest rate and any fees associated with the loan, including prepaid interest points. Pre-approval. A pre-approval is a letter issued by a lender indicating the loan amount for which the borrower is eligible. Dual tracking. Dual tracking is a situation where a lender continues to pursue foreclosure proceedings on a property while also considering other alternatives to foreclosure, such as a loan modification. Mortgage-backed securities, or MBS. Mortgage-backed securities are a type of financial investment that are similar to a bond and consist of a bundle of mortgage loans that are purchased from the banks that issued them. MBS investors receive periodic payments derived from the principal and interest payments made by the borrowers on their underlying mortgages. Adverse action. Adverse action is when a lender denies a credit application or implements other negative measures against a borrower, such as an increased interest rate or a decreased credit limit. Qualified mortgage, QM. A qualified mortgage is a loan that meets strict guidelines set by the Consumer Financial Protection Bureau under the Dodd-Frank Act, designed to eliminate risky loan features and ensure borrowers have the ability to repay their mortgages. Buy-down. A buy-down is an upfront payment of fees or prepaid interest on a mortgage loan that lowers the borrower's interest rate for a specific period, leading to temporary reductions in monthly mortgage payments during this time. Loan estimate, or LE. A loan estimate is a document provided by a lender to a borrower that includes an estimate of the monthly principal and interest payments, along with other loan terms such as the interest rate, loan amount, and estimated closing costs. Disintermediation. This is the transferring of funds from banks and intermediaries to alternative investments with potentially higher returns. Gift. A gift is money given to a borrower, usually by a family member or friend, which does not need to be repaid and are used to contribute towards the down payment or closing costs of a home purchase. Government-sponsored enterprise, or GSE. A GSE is a group of financial service corporations, including Fannie Mae and Freddie Mac, that are designed to promote the stability and affordability in the mortgage market by purchasing and securitizing mortgages to ensure reliable and steady supplies of mortgage funding. Lien. A lien is a creditor's claim against a piece of property due for the non-payment of a debt. Securitization. Securitization is the process of pooling multiple mortgage loans into a single package and selling them as mortgage-backed securities to investors on a secondary mortgage market. Combined loan to value. Combined loan to value, or CLTV, is a ratio that expresses the total amount of outstanding mortgage loans secured by a property, including any secondary mortgages or home equity lines of credit, divided by the property's value. Defeasance clause. A defeasance clause is a contractual provision that outlines specific conditions under which the mortgage or other encumbrance on a property can be voided or discharged, including the fulfillment of the mortgage obligation. Conforming loan. A conforming loan is a loan that meets the standard guidelines set by the government-sponsored enterprises like Fannie Mae and Freddie Mac, typically including loan amount limits and borrower's credit worthiness. Debt. Debt in terms of mortgage lending is any monthly recurring financial obligation such as loans, credit card payments, and more. Money laundering. Money laundering is concealing financial assets generated from illegal activity to make it appear legitimate, usually by passing it through a series of bank transfers or commercial transactions so that it can be used without raising any suspicions or triggering any legal scrutiny. Finance charges. Finance charges are the total cost of a mortgage expressed as a dollar amount over the life of a loan, including any interest, service charges, mortgage insurance premiums, and any other costs or fees associated with taking the loan. Fannie Mae. Fannie Mae stands for the Federal National Mortgage Association, is a publicly traded, government-sponsored secondary mortgage market enterprise. Fannie Mae and Freddie Mac are two of the largest entities that buy mortgages on the secondary mortgage market. Mortgage fraud. Mortgage fraud is the deliberate act of misrepresenting or omitting information in the mortgage lending process to secure a loan under false pretenses. Uniform Residential Loan Application. The Uniform Residential Loan Application is a standardized form used when a borrower is applying for a mortgage. This is also known as Fannie Mae Form 1003 or Freddie Mac Form 65. Closing costs. Closing costs are fees associated with the home buying process, which may include attorney's fees, title insurance premiums, recording fees, and more that are due at the time of closing. Rate lock agreement. Also known as a lock-in agreement, an agreement in which a lender guarantees a specific interest rate on a loan to a borrower for a set period of time, ensuring the rate remains unchanged even if the market rates fluctuate. Equal Credit Opportunity Act, or the ECOA. The ECOA is a federal law that prohibits discriminating against borrowers belonging to any protected class, ensuring fair and equal access to credit and mortgage opportunities. Discount points. Discount points are upfront fees that can be paid to lower the mortgage interest rate. Each discount point typically costs 1% of the loan amount and reduces the interest rate by a specific amount, often a fraction of a percentage point. Accrued expenses. Accrued expenses are an item on the settlement statement that has been incurred but not yet paid, such as mortgage interest. Consummation. Consummation is the finalization of a loan transaction when the borrower and the lender sign the loan documents and the borrower accepts the loan funds. Interest rate cap. The interest rate cap limits the amount by which the interest rate can increase during a specific adjustment period or over the life of an adjustable rate loan. Deficiency judgment. A deficiency judgment is a legal ruling where a lender obtains a court order to pursue the borrowers for the remaining debt after a foreclosure sale, aiming to collect the shortfall between the sales proceeds and the outstanding loan balance. Secondary mortgage market. The secondary mortgage market facilitates the buying and selling of existing mortgage loans, providing liquidity to the lender so that they can originate new loans, thereby increasing the availability of mortgage credit for the home buyers. All right, welcome to the bonus section. Here are my top 10 mortgage acronyms. Let's get into them. AARMR stands for the American Association of Residential Mortgage Regulators. The AARMR is a professional organization that represents residential mortgage regulators throughout the U.S. that aim to promote effective regulation and supervision to safeguard consumers and uphold the integrity of the mortgage market. TILA, or the Truth in Lending Act. TILA is a federal law that requires lenders to provide borrowers with clear and accurate information about the terms, costs, fees, and conditions of a loan, including the annual percentage rate and any repayment terms. RESPA, or the Real Estate Settlement Procedures Act. RESPA is a federal law that was designed to protect consumers in real estate transactions and requires lenders to provide borrowers with specific disclosures about loan terms and settlement costs. ARM, or Adjustable Rate Mortgage. An ARM is a type of home loan where the interest rate fluctuates periodically based on market conditions, resulting in changes to the borrower's monthly mortgage payments over time. PITI stands for Principal, Interest, Taxes, and Insurance. PITI is an acronym that represents the four components of a typical monthly mortgage payment: principal, interest, taxes, and insurance. DTI, Debt-to-Income Ratio. The DTI is a financial metric used by lenders to assess a borrower's ability to manage their debt payments relative to their income. MLO, Mortgage Loan Originator. An MLO is a licensed professional who helps borrowers through the mortgage application process, serving as the primary point of contact from the initial application to the final approval and acquisition of the mortgage loan. CD, Closing Disclosure. The CD is a detailed document provided to the borrower by the lender that summarizes the final terms and costs of the mortgage loan, ensuring transparency and compliance with lending regulations. PMI, Private Mortgage Insurance. PMI is a type of mortgage insurance sometimes required if you have conventional financing without meeting a minimum down payment amount. LTV, Loan-to-Value Ratio. The LTV is the amount of the mortgage loan compared to the current market value of the property.